The trading floor is silent in a way it was never designed to be. Screens flicker with red numbers, not just losses, collapsing values, vanishing liquidity. A risk manager in New York refreshes his dashboard for the 5th time in 10 seconds. The numbers don't change, they only get worse. Across the ocean, a central banker stares at a spreadsheet that no longer behaves like a model. Billions are being erased, just gone. And the strange part is this: every system in place was designed to prevent exactly this outcome. Every regulation was built to make markets safer. So how does a system engineered for stability repeatedly produce instability? How do tools designed to reduce risk end up multiplying it? This is the story of how financial problems are created, and how the solutions we build often plant the seeds of the next crisis. At its core, finance begins with a simple problem: time. The mismatch between when money is needed and when it exists. A farmer needs seeds today, but the harvest comes months later. Finance emerges as the bridge across time. Banks, in their earliest form, solve this by connecting those who have money today with those who need it now. It is a system of trust. But trust alone is fragile, so the system evolves. Risk is priced. Every loan carries uncertainty. Will the borrower repay? Think of it like this. Instead of one person carrying a heavy load, the system spreads the weight across many shoulders. This is the promise: diversification, liquidity, efficiency. A world where risk doesn't disappear, but becomes manageable. Originally, risk was personal. A lender knew the borrower. Decisions were grounded in human judgment. Then came scale. Loans were bundled together. Investments were packaged into financial products. Markets expanded beyond local communities into global networks. And with scale comes distance. The person making the decision is no longer the one bearing the consequences. This is moral hazard. Now imagine the system as a machine. Money flows in one side: savings, deposits. It gets processed: loans, securities, and it outputs growth. Instead of holding a home loan for 20 years, the bank bundles it. These bundles are sold as securities. Now the risk is with the investors. These securities are sliced into layers, some safer, some riskier. Insurance-like instruments are created to protect against default. Each layer adds efficiency. Each layer also adds complexity, and complexity introduces opacity. The system becomes more sophisticated in measuring risk, but less capable of understanding it, because you can't trace the origin of failure. Because most financial models operate on a dangerous assumption that extreme events are rare, but human behavior does not follow neat patterns. In any system, there is a trigger: a collapse in asset prices, a loss of confidence. When that happens, the system doesn't absorb the shock, it amplifies it. Many institutions operate with leverage, borrowed money used to increase potential returns, but it works both ways. If you borrow to invest, a 10% loss can wipe out your entire capital. Forced selling begins, a feedback loop. This is how financial problems escalate, not through a single failure, but through interconnected reactions. What is safe for one becomes dangerous for all. Historically, this pattern repeats. From banking panics in the 19th century to stock market crashes in the 20th, the dynamics remain the same. So where do solutions come in? Every solution changes the system, and when the system changes, new problems emerge. Regulation makes traditional banks safer, but it pushes risk elsewhere, into shadow banking, into private funds. The risk migrates. Innovation, like derivatives, was created to hedge risk, but it also allows for speculation at scale. It concentrates risk in unseen ways. Financial problems are not bugs in the system. They are consequences of its design. Every attempt to optimize introduces trade-offs. The real question is how to understand finance as a dynamic system, a network of incentives, behaviors, and interdependencies. Because once you see the system clearly, you begin to notice the same patterns repeating, the same risks being underestimated, just in different forms. And that realization changes everything. The failure doesn't begin with panic, it begins with confidence. A market that has been stable for too long starts to believe in its own stability. Risk models show low volatility, defaults remain rare, returns look predictable. Participants begin to trust not just the system, but the assumptions behind it. And that's when the system becomes most fragile. Because stability, in finance, often plants the conditions for instability. Let's walk into a real scenario. A housing market expands rapidly. Prices rise steadily. Loans become easier to obtain. Financial institutions begin to treat this growth as a permanent feature, not a temporary phase. The logic seems sound. If housing prices always go up, then even a risky borrower is safe, because the underlying asset gains value. So lenders loosen standards. Borrowers take on more debt. Investors demand more securities backed by these loans, and the machine accelerates. Now let's break down the plumbing, the actual mechanics of how the system operates. Step 1, a bank issues a mortgage. Step 2, that mortgage is bundled with thousands of others into a mortgage-backed security. Step 3, the security is divided into layers or tranches. The top layer gets paid first. The bottom layer absorbs losses. Step 4, these securities are sold to investors. Step 5, institutions create derivatives that insure against default. So now, risk has been sliced, packaged, insured, and distributed across the entire financial system. On paper, it looks minimized. In reality, it has been obscured. The system designed to distribute risk actually concentrates it. Because when everyone relies on the same assumptions, the system becomes synchronized, and synchronized systems fail together. The catalyst, when it arrives, is almost always underestimated. In this case, it's simple. Housing prices stop rising. But that's enough. Because the entire structure is built on continuous growth. Borrowers can't refinance anymore. Defaults begin to increase. Losses hit the lowest tranches first, then they move upward. Now, something critical happens. Uncertainty replaces confidence. And in finance, uncertainty is more dangerous than loss, because loss can be calculated, uncertainty cannot. So participants react. They stop lending. They start selling. Liquidity begins to disappear. Markets freeze. This is the moment where a financial problem becomes a crisis, not when losses occur, but when trust breaks. Banks reduce lending. Businesses can't access credit. Economic activity slows. Layoffs begin. The market collapse happens in months. The recovery takes years. Confidence rebuilds slowly. This isn't just one crisis. This is a template. The same structure appears again and again, only the assets change. Look at modern markets. ETFs promise liquidity and diversification, but consider the underlying mechanism. An ETF may hold illiquid instruments, yet the ETF itself trades instantly. Liquidity on the surface, illiquidity underneath. Or take private equity. As more capital flows into these markets, pressure builds to provide liquidity. Secondary markets emerge. Even in crypto markets, the blueprint repeats. Decentralized finance platforms offer lending without traditional intermediaries. Smart contracts replace banks. Algorithms replace human decision-making. But instead of credit risk, you have code risk. Across all these systems, one idea remains constant. Financial problems emerge from mismatches. So what are the solutions? First, transparency, the ability to see where risk actually resides. Second, alignment of incentives, a system where those who create risk are also exposed to it. Third, resilience over efficiency. Resilience means accepting inefficiency, holding extra capital, preparing for unlikely scenarios. Fourth, understanding leverage. Leverage amplifies outcomes. Too much in the wrong place leads to rupture. Fifth, behavioral awareness. Fear spreads faster than information. Markets are not just mathematical systems, they are psychological systems. Whenever you encounter a financial product, ask, where is the risk located? Who ultimately bears it? This framework doesn't predict crises. It reveals vulnerabilities, and that's more powerful. Now, return to that moment, the trading floor, the frozen screens, the risk manager staring at numbers that no longer make sense. He was witnessing the visible phase of an invisible process, a system that had been building pressure for years, designing systems that acknowledge uncertainty, that expect failure, that absorb shocks instead of amplifying them. The goal of finance is not to eliminate risk. That would eliminate opportunity itself. The goal is to understand risk deeply enough to survive it. So the next time you hear about a market boom or a sudden collapse, don't just ask what happened. Ask how the system made it possible. Because once you see the structure, you stop reacting to headlines and start understanding the game. And in finance, understanding the game is the only real advantage.